Silver just did something gold couldn't after CPI. Inflation has just come in hotter than expected again. Gold weakened almost immediately, but silver did something very different. And that may be one of the most important signals in the metals market right now. Because while gold reacted to fears of higher interest rates and a firmer dollar, silver held on to one of its strongest breakouts of the year. And when you combine that with rising oil prices, continued strength in platinum, and a gold to silver ratio now approaching levels not seen for quite some time, the bigger picture starts becoming much more interesting. Welcome to the 2% Brief. The latest CPI figures came in above expectations, with year-on-year inflation rising to 3.8%, while core inflation also moved higher. At the same time, oil prices remain elevated, with Brent crude above $107 and WTI above $101. That matters because markets are increasingly beginning to question whether inflation is really under control. And that immediately affects expectations around interest rates, the dollar, and future monetary policy. In fact, markets are now pricing in roughly a 70% probability of another Federal Reserve rate hike by early 2027, while expectations for rate cuts this year have been reduced sharply. That tends to strengthen the dollar and place pressure on gold, and that is broadly what we saw today. Gold weakened following the CPI release and is currently trading around $4,680, but silver did not react in the same way. To be clear, silver did not suddenly surge higher today either. That's not the story here. In fact, silver eased slightly intraday, but after an enormous move over the past week, rising roughly 15%, silver has held on to most of that breakout. And that is the important part. Gold weakened structurally after the CPI release. Silver didn't. That divergence matters. Because although gold and silver are both precious metals, they do not always respond to the same forces in the same way. Gold is primarily a monetary metal. It is highly sensitive to real yields, interest rate expectations, and movements in the dollar. Silver is different. Silver sits between monetary metal and industrial commodity. So when inflation pressures begin interacting with industrial demand, commodity strength, and supply concerns, silver can sometimes start behaving very differently from gold. And right now, that may be exactly what we're beginning to see. Oil remains elevated. Energy prices continue feeding into inflation expectations. Geopolitical tensions in the Middle East continue creating uncertainty around shipping routes, supply chains, and future energy costs. That broader inflationary pressure may be helping support industrial and hard asset demand, even while gold faces pressure from higher rate expectations. And silver is not alone. Platinum is also trading strongly, currently near the $2,100 level after another solid weekly advance. Meanwhile, Bitcoin remains elevated above $80,000 despite weakness in equities, suggesting that capital is still looking for alternatives outside traditional fiat-sensitive assets. Now, if you're finding this analysis useful so far, please do take a moment to like the video, subscribe to the channel, and share it on social media. It genuinely helps the channel reach a much wider audience. What we may be witnessing is not simply a gold story. It may instead be the early stages of a broader hard asset repricing story. And this is where the story becomes much more important. Because markets are no longer reacting in the simple way many investors had become used to over the past year. Previously, weaker growth expectations and hopes for future rate cuts tended to support almost all areas of the precious metals complex simultaneously. But now the market appears to be differentiating much more aggressively between monetary sensitivity and industrial inflation sensitivity. Gold is increasingly reacting to the interest rate side of the equation. Silver, meanwhile, appears to be reacting more to the persistence of inflation itself, especially when combined with elevated energy prices, supply concerns, and continued industrial demand expectations. That distinction matters because if this divergence continues, investors may begin reassessing the role different hard assets play within portfolios during periods of structurally higher inflation. And that could potentially create a very different environment for metals markets during the second half of this year, compared with what many analysts expected only a few months ago. And this may also be the part the market is still underestimating. Because if silver continues outperforming while gold stabilizes rather than collapsing, the implications become much larger than a simple short-term precious metals rally. And one of the clearest ways to see that is through the gold to silver ratio. Now, for newer viewers, the gold to silver ratio, or GSR, simply measures how many ounces of silver it takes to buy 1 ounce of gold. When the ratio falls sharply, it means silver is outperforming gold. And right now, the ratio has compressed towards 55, one of the lowest levels we've seen for a considerable period of time. That matters because periods of rapid GSR compression often signal stronger momentum and broader participation across the metals complex. Now, of course, this does not automatically mean silver moves in a straight line from here. Markets rarely behave that way. And if the dollar strengthens materially, or real yields continue rising aggressively, silver could absolutely retrace part of this move. But the resilience itself is the signal, not the daily candle, not the intraday volatility, the resilience. Because silver is holding strength at a time when conditions would normally place far more pressure on the entire precious metals complex. And markets tend to pay attention when unusual divergences begin appearing across multiple asset classes simultaneously, especially when oil remains elevated, inflation is proving persistent, and hard assets continue outperforming expectations. Now, one thing I do want to stress is that I do not interpret every move in gold or silver as evidence of some immediate financial collapse scenario. That is not what this channel is about. But I do think it's important to recognize when markets begin sending signals that do not entirely fit the mainstream narrative. Because much of the past year, the dominant assumption was that inflation would continue cooling steadily. Rates would eventually fall and markets would normalize relatively smoothly. But markets are now beginning to question whether that path is quite so straightforward. And silver holding this breakout while gold weakens may be part of that broader reassessment. And if that reassessment continues, then the relationship between inflation, rates, commodities, and hard assets may become one of the most important macro stories to watch during the remainder of this year. And if you want deeper analysis, especially the more detailed Sunday strategic briefings covering gold, silver, oil markets, and the broader macro picture, then do consider joining us over on Substack at the 2% Brief. The link is in the description and comment section below. And finally, at the end of this video, YouTube will recommend some of my latest silver analysis videos. If this subject interests you, I strongly recommend watching those next, because they connect directly with what we've discussed here today. Thank you very much for watching. I'll see you in the next video.